Good afternoon. My name is Erin Miller, and this is my strategic management analysis for Citigroup for MBA 690 Strategic Management with Professor Brandon Schulte. Citigroup's history can be traced back to 1812. According to Wild, Citigroup's history is one mixed with patriotism and gore. The bank has played key roles in supporting the country's rise to power, as well as playing a role in nearly every financial crisis in American history. In 1811, the charter of the First Bank of the United States was allowed to lapse, and in its wake, the City Bank of New York, known today as Citigroup, was created. When it comes to location globally, Citi holds the winning hand. The bank's locations span over 125 countries, making it the largest financial entity in the world. Citigroup is headquartered in New York City and is a global financial services holding company. While the company started out as a chartered bank, throughout history and thanks in part to deregulation, it has expanded its operations. When analyzing Citigroup's mission statement against David and David's 9 criteria, it is strong but fails to include all characteristics. The mission does not reveal that the firm is environmentally responsible and omits certain components such as markets and technology, perhaps including something about exploring technology-enabled services to help eliminate the need for natural resources could help ensure the coverage of all. I believe that Citigroup use of responsibility in their mission statement provides reconciliatory feelings from the public based on their extensive risk-taking and aid in the financial crisis. Citigroup does not provide a vision statement, which is unfortunate because according to David and David, a clear vision statement should be established first and foremost because it provides the foundation for developing a comprehensive mission statement. Perhaps a good vision statement for Citigroup could be, Citigroup's vision is to be the most well-known financial services firm in the world, enabling growth and economic progress for households and businesses. It is clear, concise, and acknowledges where the company wants to go. While Citigroup does not provide a vision statement, they do provide a thorough value proposition. Citigroup engages in the provision of a range of financial products and services, including consumer banking and credit, corporate investment banking, securities brokerage, trade and securities services, and wealth management. It operates through the Citicorp and Citi Holdings segments. The Citicorp segment consists of the company's global consumer banking and institutional clients group, as well as corporate and other functions. The Citi Holdings segment contains the non-core businesses and comprises only about 6% of the overall company. Citigroup's product lines all carry the Citi prefix, making them easy to identify. The Global Consumer Banking, or GCB, generates revenues from fees and interest spread between deposits and loans. Citigroup also receives revenue from the interest rates associated with their credit cards. In the U.S., the credit card business is a $90 billion a year industry, and growth rates are expected to be around 2.5% annualized through 2020. Citi makes money from 3 key areas: interest income, interchange fees, and cardholder fees. All 3 revenue streams account for approximately 1/3 each of total revenues. The Institutional Clients Group, or ICG revenue, is generated primarily from fees and spreads associated with activities. ICG earns fee income for assisting clients in clearing transactions, providing brokerage and investment banking services, and other such activities. Other revenue is generated from transaction processing and assets under custody and administration. Also, as a market maker, ICG facilitates transactions, including holding product inventory to meet client demand, and then earns the differential between the price at which it buys and sells the products. The key activities of banking's value chain analysis are the development and maintenance of customer relationships, the provision of financial advice, product development and provision, and the processing of transactions. The supporting activities, which must be carried out across all phases, are in part sector-specific and include risk management, compliance and regulation, and financial analysis. And lastly, in part generic, HR, IT, and management. Based on Porter's 5 generic competitive strategies, Citigroup seems to have adopted the differentiation strategy in conjunction with a best value focus strategy. While other big banks are achieving growth through acquisitions, Citi is setting themselves apart. Rather than focusing on quantity, the company is focusing on quality in a smaller niche segment. To gain a competitive advantage, Citi is also using their global reach, coupled with digital innovations, to target high-quality, affluent-oriented client base. Citi's use of their global network, risk, data, and analytics, and their distinctive brand allows them to focus on their customers and provide them with exceptional quality service. Looking for a history of ethically questionable practices needs to look no further than the financial collapse. The financial crisis had a global impact and cast long shadows that are still felt. While legally no wrongdoing occurred, the events that led to the collapse represent an ethical dilemma. Citigroup, albeit many other financial institutions, lacked principles and in doing so conducted unethical business practices. Consumers looked to banks to help facilitate many of their financial needs, and Citigroup violated this trust. While there has been debate surrounding who is to blame for the financial crisis, Citigroup undoubtedly contributed to it through its use of unethical business practices. Citigroup has come a long way in the last decade, in part to stringent regulations that arose out of the result of the financial crisis, and in part to new leadership. It is hard to maintain whether Citigroup has learned from their mistakes, and while they seem to be doing a better job at following their code of conduct, there are potential ethical issues that have arisen. In the aftermath of the financial crisis, Citi has worked to sell off its subprime lending segment. However, it may be finding other manners to still engage in subprime lending. Despite tough new regulations aimed at lowering risk for banks, Wall Street continues to find ways to finance subprime loans. Instead of direct lending, big institutions like Citigroup loan money to non-bank institutions, known as shadow banks, who then deal with high-risk clients. Citi maintains that lending to non-banks limits their exposure. However, one big recipient of these funds, Exeter Finance, services customers with an average credit score of 570. While Citigroup itself may not directly engage in subprime lending, they are doing so indirectly, which can have an adverse impact on the economy, suggesting they may not be following their own ethical code. While it is easy to find ethical problems associated with Citigroup, thanks in part to the financial crisis, they have done things in recent years that suggest their leadership team, led by CEO Michael Corbett, is working to ensure the company operates by their own code of ethics. Citigroup's cornerstone $100 billion environmental finance goal aims to lend, invest, and facilitate the money over 10 years to activities that reduce the impacts of climate change and create environmental solutions that benefit people and communities. Moreover, the company may be working to do a better job at developing a culture where subordinates feel comfortable challenging questionable policies and orders. Dr. David Miller, a Princeton University professor, theologian, and former banker, has been hired on to be the company's on-call ethicist. Corbett, who recently raised an idea that came from Dr. Miller, said employees should ask the 4 M's when faced with uncertain situations. What would your mother, your mentor, the media, and if you're so inclined, your maker think? Corbett believes that the problem isn't bad employees, rather an environment that makes it easy for good employees to justify bad decisions when they face gray zone questions. Citigroup recently took another big step to hold up to its social responsibility by putting new restrictions on how and when corporate clients can sell guns. Citigroup said it's prepared to lose business if clients don't comply. Citigroup's Executive Vice President Edward Schuyler said the decision was not centered on an ideological mission to rid the world of firearms, but rather about implementing common sense measures that would help prevent firearms from getting into the wrong hands. Because for too many years, in too many places, this country has seen acts of gun violence that have resulted in heartbreaking losses. And as a society, we all know that something needs to change. And as a company, they feel they must do their part. While there are undoubtedly ethical skeletons in Citigroup's closet, it does appear they are working harder than ever to drive ethics into their culture and business practices. For example, to help create an ethics culture, Citigroup developed a business ethics board game that is played by thousands of employees worldwide. Called The Word Ethic, this game asks players business ethic questions, such as how do you deal with a customer who offers you football tickets in exchange for a new backdated IRA? Diana Robertson at the Wharton School of Business believes the game is effective because it is interactive. Among Porter's five forces, rivalry among competing firms is the highest. Citigroup faces intense rivalry domestically from JP Morgan, Wells Fargo, and Bank of America, as well as globally from other large multinational banks. The low switching costs for consumers intensify industry competition, although this is minimized the more products and services a customer has with the financial institution. Also, little differentiation between competitors' products and services, and mergers and acquisitions of smaller banks has made things more fierce. The threat of new competitors on the same scale as Citigroup is relatively small. Government regulations, intense capital requirements, the inability to quickly achieve economies of scale, and strong brand preferences all stifle new competitors, especially at the same level as Citigroup. The threat of substitute products has increased due to the increase in online banks lenders, as well as firms outside the banking industry now offering similar financial services. PayPal, Apple Pay, Google Wallet, prepaid debit cards, as well as the increase in online lending brokers such as LendingTree have contributed to an increase in the threat of substitute products. Most large financial institutions offer the same products and services, which drive the threat of substitute products up. Suppliers for the banking and financial services industry are the depositors. These depositors are the primary source of capital for Citigroup, and while individual depositors do not have significant bargaining power, large depositors such as corporations or individuals with high net worth have greater bargaining power. Depositors of this caliber have larger bargaining power because the loss of them would impact profitability. Lastly, Citigroup's consumers and suppliers are one and the same, which also affords them greater bargaining power. Because consumer deposits, investments, and lending needs all contribute to the company's profitability, similar to the bargaining power of suppliers, larger accounts have greater bargaining power. Citigroup's ability to offer competitive rates and attract clients from competitors is important. Here, the strategic group map for 6 of the largest U.S. banks is presented. The grouping looks at total deposits as well as total foreign deposits. Deposits are important for 2 reasons. Firstly, banks use the money from deposits to make loans. The spread between interest rates creates revenues for the banks. Therefore, the greater the deposit levels, the more that banks can lend or invest and essentially create profits. Secondly, deposits are not only part of the money supply, but they also affect it in important ways. Governments create and spread money throughout the economy in response to key movers like investment. From this map, we can see that JP Morgan, Wells Fargo, and Bank of America have a more intense rivalry with one another compared to that of Citigroup. Additionally, we see another cluster which includes Goldman Sachs and Morgan Stanley. While each of these banks represent competition for Citigroup, the map shows that Citigroup falls short in total deposits compared to JP Morgan, Wells Fargo, and Bank of America. This also shows that Citigroup is strategically setting themselves apart with their global footprint, as roughly 50% of the firm's total deposits are non-US deposits. Citigroup could also use this map to try to focus on market penetration to obtain a larger number of deposits. However, based on Citi's strategic objective to target high net worth accounts, quality over quantity, this may be a good indication that they are placed exactly where they want to be. Citigroup's EFE score is 2.61, which indicate that the company is adequately responding to existing opportunities and threats within the banking industry. Opportunities include an increase in the number of smartphone users, which means reaching unserved and underserved markets. Secondly, Citigroup has successfully partnered with several retailers, including Costco, Ford, ExxonMobil, and the Home Depot. Their established brand image, along with being the leading credit card issuer globally, could help acquire new partners. Third, Fed expects to increase interest rates 3 times in 2018. And lastly, the political changes such as reduced regulation can relax capital requirements and bolster profitability for the banking industry. Conversely, the threats include cyber risk concerns. The legal and regulatory concerns are a primary risk factor for Citi's business, both inside the U.S. and out. It affects not only the long-term business, but the balance sheet and budget planning as well. As more services are offered through online platforms, face time with customers will decline, which could mean less brand loyalty. Contextual engagement will become a source of differentiation, with the impact of automation and the ability to integrate digital and human interaction becoming a consumer expectation. Non-traditional competitors such as Apple Pay, Google Wallet, and online banks lenders could creep in and take current or prospective clients. Virtual currencies could threaten traditional financial institutions. The number of bitcoins in circulation has grown month over month and reached over 16 million as of December 2017. The near zero transaction cost has made these currencies even superior to the traditional money we are accustomed to using. And lastly, the 2008 financial crisis is imprinted on the minds of U.S. consumers. Citigroup, along with other too-big-to-fail financial institutions, received bailouts from the government that received wide criticism. By using the SWOT analysis matrix, Citigroup can use their internal strengths, such as strong financial position, brand image, and global reach, to take advantage of external opportunities and reduce or avoid possible external threats. For example, being one of the big banks within the U.S., they can lobby for deregulation or acquire smaller banks to gain market share. Additionally, Citigroup could use their strong financial position and brand to help them grow their global consumer banking segment by using their market dominance and strong brand image to acquire smaller banks in key markets, as well as beef up their global reach by utilizing online and mobile technology. Citigroup can also use the SWOT analysis to improve internal weaknesses by taking advantage of external opportunities. For example, the growth of digital banking has reduced the need for branch locations. The reduction of branches and thus overhead dollars can be used to create efficiencies and develop stronger mobile and technological platforms. They can also take and refocus their client base to divest profit-draining business lines and reinvest those in capabilities that allow them to serve better and retain high revenue-generating lines of business. Lastly, Citigroup can use the SWOT analysis to identify and reduce internal weaknesses and external threats, such as reducing cyber risk threat by increasing their cyber risk insurance and developing disaster recovery plans. The CPM matrix reveals strengths and weaknesses of each company. The matrix provides a visual method to compare scores for your company with that of their rivals. If a company has a relative strength in product quality, then they will want to protect this strength while improving in an area with a lower score. Based on the factors in the CPM, JP Morgan Chase leads the pack, followed by Bank of America and then Citi. Citigroup has a smaller market share compared to its bigger competitors, which contributes to smaller revenues and income levels. Citigroup does outperform both rivals with ATMs. And because all three operate in similar markets and provide similar products, Citigroup's offering of more fee-free ATMs is an important differentiator. Citi surveyed customers to find out what they wanted from a bank that they could not get from smartphones, and the answer was access to cash when and where they needed it. According to Wells Fargo bank analyst Mike May, for Citigroup to leverage the ATM network with digital banking to be a super branch-light national banking player could make sense. In the BCG matrix, global consumer banking segment is primarily positioned in the stars quadrant, but teeters on the question marks quadrant. This makes sense because while they are strong long-run opportunity regarding growth and profitability, Citigroup must invest substantially in this segment to maintain or strengthen their dominant position. Banks such as Citigroup must engage in intense market penetration strategies to maintain and/or create market dominance for themselves. The institutional clients group is primarily situated in the stars quadrant. Because ICG falls in the stars quadrant, this segment should receive substantial investment to maintain its dominant position. Forward integration, market penetration, market development, and product development are appropriate strategies for this segment to consider. One example of Citigroup's market development and penetration occurred when Citi was granted a license by the Capital Market Authority in Saudi Arabia that enables the bank to provide a full range of investment, banking, debt, and equity capital markets and securities research services to local and international institutional clients. The SPACE matrix utilizes a four-quadrant framework, which is used to indicate whether aggressive, conservative, defensive, or competitive strategies are most appropriate for a given organization. According to David and David, these four factors are perhaps the most important determinants of an organization's overall strategic position. Citigroup is positioned in the aggressive quadrant of the SPACE matrix. While Citigroup's revenues lag JP Morgan Chase and Bank of America, the difference is not significant. Overall, Citi and its competitors have a strong financial position and all face the same industry pressures. Competitive pressure and government regulation pose the biggest external threats. However, these are equally as diminishing to their biggest competitors. Continuing to pursue the market penetration and horizontal integration in the consumer banking, as well as market development and penetration in the ICG segments, is instrumental. The QSPM matrix reveals that the creation of new partnerships, such as Amazon, IKEA, or Nordstrom's, is a slightly more attractive strategy than increasing advertising to go after market share for GCB presence in Latin America and Asia. This makes sense considering partnerships with leading retailers has created a strong position for Citi. Secondly, a new partnership strategy carries smaller legal and regulatory concerns, whereas growth in Latin America and Asia carries more regulatory risk. Overall, the strategy to increase presence in Latin America and Asia is not necessarily a bad strategy, it is just not as attractive as creating a new partnership. Financial institutions have been working to get back to the health following the financial crisis, and Citigroup is no exception. Based on the reported financials over the following 3 years, the company appears to be gaining the momentum to obtain the financial health they experienced before the crisis. Citigroup's revenues grew 2.3% from 2016, but was down 6.4% from 2015. The company has seen growth in institutional clients group in every region in global consumer banking. Citigroup's strong expense management in 2017 resulted in an efficiency ratio of 58%, which was down from 2016. According to Shafto, the average efficiency ratio for all FDIC-insured banks was 61.6%, while banks with total asset bases larger than $1 billion, the average efficiency ratio was 59.4%. The earning potential of banks is driven largely by the net interest spread. Citigroup's net interest margin has slowly declined over the past 3 years. This makes sense since interest rates have been at a historic low since the financial crisis. According to the FDIC, net interest margin across insured institutions was up to 3.31%. The upside for Citigroup is that the Fed is expected to raise interest rates in 2018. Low unemployment along with favorable economic conditions should help boost their net interest margin. Additionally, Citigroup has recently raised its base lending rate from 4.5 to 4.75%, which should also help increase their net interest margin. The passage of tax reform legislation in the U.S. in the fourth quarter of 2017 resulted in a one-time non-cash charge of $22.6 billion, resulting in a net loss on a reporting basis for the year of $6.8 billion. The one-time non-cash charge is merely a short-term pain that will have long-term gains for Citigroup, as the corporate tax rate will fall from 30% to 21%, which will boost the bottom line going forward, thereby helping to increase net profit margins. Earnings per share, excluding the tax impact, rose to $5.33, which is up 13%. During 2017, Citi returned a total of $17.1 billion of capital to common shareholders in the form of share repurchases and dividends. This, along with solid financial performance, helped push the upward pressure on the stock price, which rose 25%. When determining the profitability of banks, EPS isn't the only gauge. It is also important to determine how efficiently a bank uses its assets and equity to generate profits. Besides net interest margin, return on assets and return on equity can be useful profitability ratios. ROE is influenced by ROA and also by the bank's degree of financial leverage. Citigroup has increased their leverage, but as noted, can only do so as long as it continues to meet capital requirements. aka Basel III. In terms of ROA and ROE, 1% and 10% respectively are considered to be good performance numbers. And according to the Federal Reserve of St. Louis, for the fourth quarter of 2017, the average across all U.S. banks for ROA and ROE were 0.95% and 8.4% respectively. While banks can increase leverage to boost ROE, banks with low leverage are better equipped to weather adverse macro environments. According to Bauman, financial companies will always have some leverage for sufficient capital buffer. Citigroup's leverage ratio of less than the suitable maximum level of 20 times at 9 times is considered to be very cautious and prudent. This means the bank has a sensibly high level of equity compared to the level of debt it has taken on. Loan and deposit growth are both important variables for Citigroup. Net interest income and provisions for loan losses are the core operations and help drive profitability. The loan-to-deposit ratio, the LDR, helps assess liquidity and also risk aversion and management. A combination of prudence and regulatory requirements suggests for a traditional bank, the LDR should be around 80 to 90%. However, banks like Citigroup, which are highly diversified, tend to have lower ratios. This ratio seems to be inversely proportional to the degree of diversification in the business model. The more diversified the bank offerings, the lower the LDR figure. Citigroup's compounded annual growth rate, net income for the 3 years, was negative 2.87%. While revenues increased from 2016 to 2017, there was a sharp decline from 2015 to 2016, which impacted the overall 3-year rate. Revenue decline from 2015 to 2016 was related to a reduction in its non-core assets of Citi Holdings. Overall, the banking industry is performing well, and Citigroup is no exception. Earnings are at record levels post-financial crisis, interest rates are creeping up, and according to Chris Vanderpool, a senior analyst at the S&P Global Market Intelligence, the industry and certainly the big banks are in good shape. Banks are in a healthy capital position, and there haven't been any red flags in terms of credit quality. From a strategic perspective, Citigroup is performing well. From an industry perspective, the largest 5 U.S. banks control nearly 45% of the total industry's assets. Citigroup currently resides at number 4, falling short to JP Morgan Chase, Bank of America, and Wells Fargo. Furthermore, Citigroup ranks in the top 10 in the global banking industry. Citigroup has been working to restructure operations and focus primarily on a more segmented market, the high net worth clients. Additionally, Citigroup's continued efforts to diversify their credit card portfolio and attract and retain new partnerships, like Costco, has helped the company be successful from a strategic performance. In addition, Citigroup has been trimming non-essential business segments, focusing on a more segmented market niche, and focusing on delivering digital platform capabilities. While the company is not going after the masses, their strategy appears to be delivering well for them. Physical branch counts are down 21% from 2013. Relationship managers and financial advisors are up 15% from 2016. Global ATMs are up 57% from 2016. Mobile users are up 42% from 2016. And to top it off, Citi has 50+ digital partnerships. Based on the analysis thus far, I have 2 recommendations for Citigroup. The first is to cultivate and obtain new partnerships. In the U.S., partnership with Amazon, IKEA, and Nordstrom's could be advantages for Citi. The Costco co-branded credit card portfolio added 2.1 million new accounts and $166 billion in purchase sales. According to Gray, interest rates on credit cards average between 12 and 14% and significantly more if they are considered high risk. New partnerships have the potential to help increase Citi's net interest margin, since interest rates on loanable funds are significantly greater than that of the federal funds rate. While there is an upside for net interest margin, Citigroup should continue to be mindful of the creditworthiness of clients. With additional credit card lending comes the potential for greater revenues, but also result in higher provisions for credit losses. The second recommendation is to create ambassador teams that are responsible for cultivating and obtaining clients, both for GCB and ICB segments. Ambassador teams would target high net worth clients, businesses, and corporate clients. Through personalized relationships, ambassador teams would identify and facilitate the gamut of financial needs of their customers. personalizing relationships, these ambassador teams would be able to identify needs, thereby helping their clients, while also increasing the portfolio of services. This would help Citigroup in two ways. First, it would help attract and retain their customer base, and also by providing services across the financial portfolio would help reduce switching costs because large-scale financial account change is fairly difficult and cumbersome. Their ability to cultivate and maintain these relationships will help alleviate the highly competitive nature of the financial sector. By strengthening these relationships and providing solutions to help conduct daily operations, to hire, to grow, and to succeed, they will become a trusted advisor and lender. Therefore, as Citi's institutional clients innovate and grow, the relationships and successes will allow for future business. Secondly, creating ambassador teams rather than focusing on individual relationships helps with retention because no single employee within the bank would have sole access to client accounts. Therefore, while employer retention is important, the concern of losing large accounts is diminished if there is a team relationship. Additionally, the risk of having key employees recruited to competitors and taking the relationship with them is lessened. We believe Citi is poised for sustainable growth and improved returns through creating strong franchise and growing markets and driving client-led growth and improved returns. These strategies are in line with the recommendations provided above. For example, the first recommendation was to create new partnerships with Amazon. Citigroup's strategy involves having a light physical footprint and leading global capabilities and partnerships that differentiate themselves from their peers. A partnership with Amazon fits in with this strategy. Furthermore, Citi has also begun to develop a relationship with Amazon as it now allows Thank You Rewards cardholders to redeem their rewards for purchases at Amazon. Moreover, Citi is focused on creating stronger relationships with its customer base. In 2017, Citi increased the number of relationship managers and financial advisors by 18% and opened a dedicated wealth center in Miami and broke ground on another one in San Francisco to provide clients with personalized service, industry-leading expertise, and a distinctive experience. My recommendation takes their strategy a step further and focuses on a team approach rather than a personal one. Lastly, we believe that implementation of these recommendations could provide gains for Citigroup, as shown in the projected financials. The strategic management process results in decisions that can have significant, long-lasting consequences. Erroneous strategic decisions can inflict severe penalties and can be exceedingly difficult, if not impossible, to reverse. Therefore, most strategists agree that strategy evaluation is vital to an organization's well-being. Timely evaluation can alert management to problems or potential problems before a situation becomes critical. Citigroup appears to be doing a great job of reviewing and evaluating their strategy. The company is required to provide quarterly and annual financial performance to SEC and the investors, and in doing so, they are regularly comparing their actual performance to expectations and providing an evaluation of any differences. Furthermore, to stay atop technological changes that may impact their strategic goals, Citi has created innovation centers to evaluate and invest in fintech firms and deploy new digital innovations. Lastly, Citi is continuously looking for consumers to understand their needs. It is for this reason that Citi has worked to decrease their physical branches and redistribute resources to increase ATMs and optimize current branches into wealth centers. Review and evaluation of their strategy and adjustments as needed has helped Citigroup perform up to their strategic plan and will continue to contribute to their success. Citigroup has been a prominent player in the banking industry for a long time. After a thorough internal and external analysis, it is evident that Citigroup has a strong plan in place and that it has and should continue to serve the company well into the future. Thank you all for your time, and now I would like to open up the floor to questions.